John, it's great to have you back, especially on a day like this where markets trying to figure out, viewers trying to figure out how much spare capacity there is to be asked if the Saudis were to agree.
Yeah, I mean, there's not a lot. I mean, if you go by the OPEC numbers, Carl, and it's good to see you again as well, they're at about 10.5 million barrels per day of production as of June. And that was an increase, actually, of 150,000 barrels for the month. Their stated capacity, they're cagey with this number, but it's around 12, let's call it, maybe a little over that. And it's hard to sustain that. So, no, there's not a lot there. But they have been, inching up their output, which has, helped a little bit in this overall situation. I mean, crude oil prices are in a decided downtrend off the highs from March on the initial invasion of Ukraine by Russia.
And Mike and I were having a discussion earlier this morning about arguments, the debate about demand destruction, at least in gasoline demand this summer. You think there are some clues there?
I tell you, Carl, we get the weekly inventory report every Wednesday morning. The implied demand figure for last week, when it came out on Wednesday, 8 million barrels a day. It was a stunner. Usually it's 9.2 for this time of year, 9.4, let's call it. So to see an 8.0 number was stunning. So now that was 1 week. It's an implied number. So we have to sort of figure out if there were things going on around the 4th of July holiday and stocking tertiary supply, inventory. So let's see if that number stays low. But if it stays that low, the economy is potentially flashing a big warning sign beyond everything else from the lack of gasoline demand.
John, how are you processing the incredibly wide range of targets on crude? We've talked to Citi at 65. We talked to Goldman at 140. I think J.P. Morgan still has a $6 gas number slated for August. I just wonder that the range of possible scenarios you really can drive a truck through.
Yeah, when these times roll around like this, Carl, I'm happy to say that I'm comfortable with 65 and 140 as a range. So, we can maneuver there. But all kidding aside, I think what those estimates highlight is this. We are in a tightly supplied situation right now, but we're slowly digging our way out of it. And we all have to be bond traders these days because what the Fed is potentially unleashing on the financial markets is going to feed into demand destruction for oil. There's no two ways about that, and induce a recession. And it's also spiking the dollar higher, which is making crude oil even more expensive for all the non-dollar countries around the world. So it's sort of a 1-2 punch for oil, which is why you can get to that $65 case. But we are so vulnerable. If we were to lose a meaningful amount of Russian oil, if we lose more oil from say Libya stays offline, or we have other problems, or even if we get any kind of series of Gulf of Mexico hurricanes, then you get to these higher ranges. So it's really a tenuous, nervous market right now, and very emotional, highly reactive to all the various headlines. It's a real macro play right now, Carl. You just can't go by the tightness in the market. You have to look at everything these days.